The following income statement and information about changes in non-cash current assets and current liabilities are reported. Prepare only the cash flows from operating activities section of the statement of cash flows for the current year using the indirect method. Cash flows from operating activities using the indirect method begins with net income. We assume that net income equals the change in cash. Then we make adjustments to reconcile net income to operating cash flow to correct for that assumption. We begin with a review of the income statement. We add back any non-cash expenses, items like depreciation and amortization, because these expenses did not reduce our cash. We subtract any non-cash revenues, items like earnings reported under the equity method, because these revenues did not provide cash. Then we adjust for any gains and losses on long-term assets, adding back the losses and subtracting the gains, as the cash flow is reported in the investing activities section. Notice that each adjustment is in the opposite direction of the impact each of these items has on the income statement. Expenses and losses are subtracted on the income statement, but we add them back as adjustments to net income. Revenues and gains are added on the income statement, but they're subtracted as reconciling items. Then we turn our attention to the balance sheet. We adjust for the change in non-cash operating assets in the opposite direction. We add any decreases and subtract any increases. Think of it as a journal entry. To decrease a current asset, we need to credit the current asset, so we increase or debit cash. An increase to a current asset requires a debit, so we would decrease or credit cash. We adjust for the change in non-cash operating liabilities in the same direction, adding back any increases and subtracting any decreases. To increase a current liability, we credit the current liability and debit or increase cash. To decrease a current operating liability, we debit the liability, which would decrease or credit cash, which leaves us with the net cash either provided or used by operating activities. So let's try this for the SONAD company. We begin with net income, $627,744. We adjust for our non-cash revenues and expenses, items that affect long-term accounts, in the opposite direction, adding back depreciation expense and amortization expense, and subtracting the gain on sale of equipment. Then we turn our attention to the balance sheet items, adjusting for current assets in the opposite direction. We subtract the increase in accounts receivable and subtract the increase in merchandise inventory. We adjust for the change in current liabilities in the same direction, subtracting the decrease in both accounts payable and salaries payable. After these adjustments, we can calculate net cash provided by operating activities, $622,870.